Think all California beach towns move the same way? Same coastline, same prices, same trends? Not anymore. Because as of April 2026, we're seeing a split that's catching investors completely off guard. San Diego beach rents are up around 8% year over year, while Santa Monica has essentially flatlined. Same ocean, same state, completely different outcomes. So what's actually driving this divide? Today, we're breaking down the hidden forces behind it. Why San Diego is defying the broader cooling trend, why Santa Monica is losing momentum, and how zoning, migration, and shifting demand are quietly creating a new class of hyper-expensive coastal real estate. Let's get into it. First, we need to challenge one of the biggest assumptions in California real estate, the idea that all coastal markets move together. From a distance, San Diego and Santa Monica look almost interchangeable. Ocean views, luxury rentals, high-income tenants, and limited buildable land. On paper, they should behave the same. But the 2026 data tells a very different story. San Diego rents are climbing roughly 8% depending on the neighborhood, while Santa Monica has stalled, with some segments even trending slightly downward. And that gap isn't closing, it's widening. That's not just a minor difference, that's a structural divergence, and it introduces something we call the resilience gap. This is the difference between markets that can maintain pricing power during a slowdown and those that can't. Markets on the resilient side don't just grow faster, they fall slower, and sometimes they don't fall at all. Right now, San Diego sits firmly on that resilient side. Santa Monica does not. So what's creating that separation? Let's start with San Diego because the story here isn't just strong demand, it's a constrained supply. Over the past year, San Diego has been dealing with a wave of zoning litigation that has slowed, or in some cases completely halted, new multifamily development in key coastal areas. Projects that were expected to break ground have been delayed. Approvals that developers were counting on have been challenged, and construction timelines have stretched far beyond original projections. In some cases, projects are in limbo with no clear timeline. At the same time, the extension of coastal height limits continues to restrict vertical development in some of the most desirable neighborhoods. So even when demand increases, supply can't respond. Developers can't simply build higher to meet demand. They can't quickly add density where it's needed most. And that creates a bottleneck. A very tight, very persistent bottleneck. The result is what we can think of as an artificial inventory floor. There simply aren't enough units entering the market to relieve pressure. So even if demand softens slightly, prices don't react the way they normally would. They stay elevated because renters are competing over a fixed pool of inventory. And in competitive markets like this, even a small shortage can have an outsized impact on pricing. But supply is only half the story. The other half is who's actually moving into San Diego right now and why. There's a clear pattern emerging across California, a southward drift. High-income renters, many of whom previously targeted Los Angeles coastal areas like Santa Monica, are now shifting towards San Diego. Neighborhoods like La Jolla, Del Mar, and Encinitas are seeing increased demand from exactly this group. And the reason comes down to one key idea: lifestyle arbitrage. Renters aren't just asking, what does this cost? They're asking, what do I get for what I'm paying? And in 2026, San Diego is offering a stronger answer. More living space, less congestion, better access to outdoor amenities, cleaner and more consistently maintained public areas, and maybe most importantly, a lifestyle that aligns with how people actually work now. Remote and hybrid work didn't just change offices, it changed geography. People are no longer tied to a 5-day commute. So instead of optimizing for proximity to work, they're optimizing for overall quality of life. And San Diego fits that model extremely well. Now compare that to Santa Monica. For years, its rental market was driven by a very specific economic engine: Silicon Beach. A dense cluster of tech companies, startups, and media firms created a constant flow of high-income renters. That demand supported premium pricing. But that model is starting to weaken. And it's happening gradually, then all at once. Many of those companies have shifted to hybrid or fully remote operations. Some have downsized their physical presence altogether, and that changes the equation. Because if you only need to be in the office a few days a month, or not at all, the incentive to pay a premium for Santa Monica specifically starts to disappear. At the same time, supply hasn't adjusted downward. In fact, certain segments, especially mid-tier luxury, are now facing oversupply. Units that were built or repositioned for a high-demand environment are now competing in a softer market, and we're seeing the results. Vacancy rates in Santa Monica's luxury and high-rise rental sector are now at their highest levels in roughly 5 years. That's not just a data point, that's a shift in leverage. Because when vacancies rise, landlords lose pricing power. They start offering concessions, free rent periods, lower deposits, flexible lease terms. And once that cycle begins, it tends to accelerate. More vacancies lead to more competition. More competition leads to softer pricing, and softer pricing can further shift market perception. So now you have two coastal markets moving in opposite directions. In Santa Monica, demand is softening, supply is relatively abundant, and pricing power is weakening. In San Diego, demand is strengthening, supply is constrained, and pricing power remains intact. But there's another layer here that often gets overlooked, and that's perception. Because real estate isn't just driven by numbers, it's driven by how people feel about a place. Right now, there's a noticeable shift in renters' priorities: safety, cleanliness, access to well-maintained public space, overall livability. These factors are carrying more weight than they did even a few years ago, and San Diego is benefiting from that shift. It's increasingly seen as more stable, more predictable, and more aligned with a working vacation lifestyle. That perception attracts demand, and not just any demand. High-income, highly mobile renters who have the flexibility to choose where they live. When that kind of demand concentrates in a supply-constrained market, something important happens. Prices don't just rise, they stick. That's the difference we're seeing right now. San Diego isn't just growing, it's resisting downward pressure. Santa Monica, on the other hand, is adjusting to it. So what happens next? From an investment standpoint, San Diego looks like the stronger short-term play. Tight supply, inbound migration, stable rent growth, but there's a risk that's easy to overlook. Zoning can change, and when it does, it can change quickly. If San Diego resolves its legal challenges or begins to ease development restrictions, you could see a wave of delayed projects hit the market all at once. This is what we call a zoning snapback, and when that happens, supply can increase very quickly. What looks like a shortage today can turn into an oversupply tomorrow. And when that shift happens, pricing tends to correct, sometimes faster than expected. On the other side, Santa Monica's current softness doesn't automatically mean long-term decline. Markets that lose pricing power often go through a reset phase. Rents stabilize. Supply gets absorbed. Demand recalibrates. And over time, equilibrium returns. Especially in locations that still have strong fundamentals, like global recognition, infrastructure, and long-term desirability. So the real takeaway here isn't just which market is winning in 2026, it's how to evaluate coastal real estate going forward. Because the old model, buy near the beach and assume appreciation, is no longer enough. Today, the real drivers are more specific. Zoning constraints, development pipelines, local economic engines, migration flows, and shifting lifestyle preferences. These are the factors that determine whether a market holds its value or starts to slip. And San Diego and Santa Monica are showing just how far apart two similar markets can become when those variables move in different directions. So here's the bigger question. Is this just a temporary divergence, or the early stages of a new coastal hierarchy in California real estate? If you want to stay ahead of these shifts and understand where the next opportunities are, make sure you subscribe to Housing IQ. Because in this market, the people with the best information make the best moves. I'll see you in the next one.